Hello and welcome. Thank you for joining us on Business Incorporated. I'm Chimezie Obi Iwago. On the show today, mixed bag for consumers in South Africa with petrol price set to rise and diesel price falls. Zambian plans to delay sales tax until January. Plus, Kenyan private sector activity little changed in July. First, we get the show started with the markets, and the global trade row continues to hit the global markets, and markets here in Africa were not left out as all the indices showed red at intraday today. The JSE index in South Africa was the worst hit with almost 2% drop. EGX 30 in Egypt was down 0.34% and the NSE index was down marginally. Kenya also closed marginally up on Friday. It was a similar case in the Middle East as Gulf stock markets dropped at intraday, mostly weighed down by banking shares as the fresh escalation in the U.S.-China trade dispute drove investors towards safer assets. The Saudi Arabian index was down 1.22%, also hit by disappointment over some corporate earnings. Qatar's index fell heavily, 4.16%, and slipped into negative territory for the year. Dubai's index fell 2.03%, with property shares the biggest drag. In Abu Dhabi, the index was down 1.87%. European stocks tumbled in the morning as a rapid escalation of U.S.-China trade tensions continues to spook investors worldwide. Global stocks suffered a bloodbath on Friday after U.S. President Donald Trump on Thursday slapped 10% tariffs on China's remaining $300 billion of exports to the United States. Well, let's talk to Ulrich. Hello, Ulrich. Good afternoon. A beautiful week to you.
Thank you. Same to you. Thank you.
Right. So the trade conflict between the U.S. and China is escalating. How is that playing out in the European markets today?
With losses, and add these up to Friday's already even more extensive losses. When you look at the markets here, Britain, the UK, the FTSE 100 is going down by more than 2%. That's the highest loss I'm seeing in the major exchanges at the moment. The DAX in Frankfurt here, where I'm standing, you can see there it is. You can see the chart behind me on the big board. It's going down by 1.5%, and you see in Germany losses, some even heavier than the average across the board, basically. Remember the German market being heavy on export-oriented and dependent big corporations, chemical and steel, or the car industry, for example, electric and electronics, heavy, like Siemens, and so it's being felt here. But also in France, where the CAC 40 is going also down by 2%, and Milan is going down by 1%. Traders here commenting that it's unpredictable how this will progress because the U.S. president has been so unpredictable. They say, yes, he can recant, he can still steer towards a deal, but investors are very nervous. And the nervousness is being seen, and they're fleeing to so-called safe havens, supposed safe havens, if you will. And that's gold, for one, 6-year high as we speak. And also the bond markets, European sovereign debt, very much in demand, first and foremost, Germany. And you have to look at the 30-year German bond. That is 30 years in the future, and Germany can take a yield that's less than zero. So investors are actually paying the German state to park the investors' money because they fear so much for the security of their money here in the situation we're in.
Now, there is now even talk of a currency war. What's the word on that where you are?
Well, people are looking at this, and they even say it's, the currency movements, the back and forth, Trump putting pressure on the Fed to lower interest rates and showing his displeasure at Jerome Powell and his FOMC colleagues not having done more last week, and then seeing the newest move by the Chinese, who have taken the yuan lower and considerably lower, and that's being seen. I talked to one economist here in Frankfurt today, not really as the start of a currency war, not that far yet, he believes, and not in the interest of anyone, but he sees it as a signal that the Chinese are ready to signal that they can respond in kind, if you will, and that basically they're ready to take any measure in order to, let's say, have Donald Trump see how willing they are to react to this.
Another development rocking Europe, the ouster of the CEO of HSBC. Why does he have to leave?
It's a bit of a mystery. I mean, the company wasn't doing all that badly. In fact, in first quarter, the profits jumped. But the share under John Flint has gone down by about 14% though in this year. And the chairman of the board, he released a statement that a change is needed to meet the challenges ahead. Now that sounds very vague, and I think people are searching a little bit for the answer. One of the explanations is that HSBC positioned itself on the wrong side of the Chinese position on the Huawei situation. Another interpretation is that the board chairman, Mark Tucker, was not okay with choosing John Flint as the CEO only 18 months ago, and he'd like to install a candidate of his own choosing. Perhaps we'll learn more about this in the days and weeks to come. There'll be a long time where we can consider what was the reason, because the chairman himself says that the search for a successor as CEO can take up to 1 year. This does not augur well for the climate, for the kind of corporate governance at this large bank, that they should oust the CEO, who's only been there since 18 months, who's a 30-year veteran of the bank, but fresh as a CEO, you know, from one moment to the next like this. The share, by the way, going considerably down on this news, -3%.
Well, Orich, the week has just started. I'm sure we have quite a lot to chew in the week. In the meantime, enjoy the rest of the day.
Thank you.